Today, folks, as a Canadian investor, I surpassed a major milestone this year, and that was getting over $200,000 in my TFSA. Now, that puts me in the 0.2% of TFSA holders, one of 34,000 out there, and you'd think I'd be over the moon. And more or less, it breaks my soul a little bit that there's not more Canadians out there that have achieved this. It's why I make these videos, because I want more people to realize what is possible and to expand this number over time, guys. We need to be part of the investing class, and I was not special, man. I was very late to the game. As many of you know, over time, every year, the government allows a certain allotted amount to be added to this tax sheltered account. And every year, every new number added just compounds on whatever the prior year was. So this account came about in 2009, and you had to be 18 to be eligible to invest. So if you were 18 in 2009 and you invested every year, today, just the contribution alone would be worth $109,000. Now, I didn't start investing, believe it or not, until 2014, but I was 18 in 2010, if I didn't just age date myself. And it breaks my heart I didn't start utilizing this account in 2010, guys. I was so damn late to doing this, but I didn't even start utilizing my TFSA until 2017. Like, started investing in 2014, didn't start understanding even what a TFSA was till June of 2017. And I don't feel like I was very special, but my God, I have grown this account 300%, or let's be exact, 299.15%. My God, the S&P is only up 177%, and I've still been able to outpace the growth NASDAQ that's up 270 something percent, guys. I don't feel special in any real way, but I do want to break down the strategy and my perspectives on how I've been able to achieve this in the very same strategy we're still implementing to this day. So if you are on a path to financial independence, if you want some inspiration, join me on your financial journey by hitting that subscribe button, folks, because I did get lucky in a sense that in 2014, I was paying very much attention to the markets and I was recognizing some growth trends that were going on. And you can see right in that same year, my account jumped up over 50%. What caused that? Well, it was the realization that we were in what was going to be a cannabis boom, guys. And if you go back to June of 2017 here, I started buying Canopy after initial bumps, and this thing ran up several 100%. Obviously, I never maximized the total growth because I am a guy that finds stocks like this. I take profits on the way up and I diversify that capital to build up my wealth preservation. So though it ran up, hundreds of percent, I was still able to capitalize on over 50% in the entire account because I diversify. I was also investing in other stocks like Northland Power, capturing the green energy trade at the same time, which I sold out of in 2022-ish, somewhere around there, making some pretty healthy gains, including the fat dividends that this company was paying out. But this is not the strategy, guys, that took my accounts to the levels where you see them today. There's been one strategy that has worked for the last 15 years in the greatest growth, the greatest bull market ever in human history. And I still think we're in the midst of this trade. I'm not telling you to do this. This is not financial advice. These are just opinions of my own. And I'm just sharing with you the transparency and perspectives that got me to this level, right? So what was it? It was simply tech, guys. I held Apple, Microsoft, Google, Tesla. These were the stocks I've been focused on since, basically I started investing in those accounts, and they are the reason that I have made up these kind of gains. And as those gains have exceeded over time, again, I took profit. I've scaled them down. I've diversified them into broad-based ETFs. This ensures that if the market tanks or these stocks start to underperform, that I'm not going to get caught up in what happened to Canopy, which is now worth less than what I was buying it for back in June, guys, of 2017. The problem is most investors, when they start getting involved in these stocks, is they have this mindset of, I have to buy and hold this forever. They get married to these companies, guys. These are investment vehicles, long-term growth vehicles. I'm not married to them. If they balloon and become too big of my portfolio, I will immediately trim them to protect the accounts. And again, you look in 2022, guys, and my accounts went down quite materially, but not as much as I've seen, because investors were really focused on growth stocks and small caps, and they saw their accounts drop up to 50, 70% in some cases. And I've been so fortunate and so diligent that I was able to utilize my TFSA in 2023 to pull out all the capital and purchase a piece of real estate, which would have never been possible if it wasn't for these investment vehicles, if it wasn't for my diligence in utilizing this account as early as I did. I am 33 today, guys, and I've recognized that I don't think Canadians today can get ahead as easily as they could have, back in our parents' generation. I think that's apparent with the price increases of houses and cost of living, and you need to find a way to become part of the investing class as early on as humanly possible, because this is what helped me achieve my goals, right? And then, after purchasing that piece of real estate, I immediately went back to rebuilding up this account to the point where I've almost maximized it back out. I've still got, I think $15,000-$20,000 worth of contribution from, which is crazy to me because this account today is already worth like $210,000. So you might look at the account today, and if you've been following the channel for a while, I've already made some good, investments in this account that I've taken profit on over time. Like Google, we made some good money on, which I still hold in my corporate accounts. And I have tech stocks spread out, and you guys don't get to see the entirety or the full vision of this because my fiance is in the midst of growing her TFSA as we try and maximize both these accounts out, and we just don't want to over concentrate. So because our TFSA is smaller, we're utilizing it for the growth phase, right? So we have those same tech companies in her account. Believe it or not, she holds Apple and she holds Meta and Google and our favorite tech companies. Well, she also has been buying the same stocks that I've been buying, obviously within my TFSA here, which is, VDY, VOO. She's still cost averaging the same indexes just to make sure if these stocks tank, she's not going to materially destroy her TFSA, but inching out those little bit of gains, guys. We're not trying to leverage into high growth only. We just want to inch out a few extra gains because through compound interest over long periods of time, those few extra percentage points can turn into hundreds of thousands of dollars over 20, 30-year periods. So within my TFSA, you might say, okay, VDY, VO, maybe that's all I'll do. I can't tell you what's going to be the most appropriate thing for you, but I don't like seeing Canadians focus on dividend stocks. It's completely foolish because they're buying, country biased stocks where they're already tax efficient. Most Canadian stocks come in at qualified dividends, and if you don't have any income and you make 50K in qualified dividends, you virtually pay zero tax. It's not really worth holding them in this tax sheltered account when maximizing growth and return is what this account generally was built for. So it's better to leverage some growth, right? And this is not financial advice. I'm not telling you to copy me. I'm just giving you the perspective that worked so successfully and continues to work successfully because it's the only trade that has propelled the markets for the last 15 years. And I don't know when that comes to an end, guys. We could be in an AI bubble. It could end next year, the year after. And yes, it would still hurt us considering the holdings between my fiance and I. But again, we've limited that risk to a level that we're comfortable with where she can still maximize growth with the end goal between both our TFSAs to be worth somewhere between 400,000 and 500,000. And we want to achieve that because if we can get market average returns and we diversify those gains into broad-based ETFs, always the plan, right? Like let the high growth carry us in our earlier years as we scale the growth down over time and put it into long-term investment vehicles that we don't really have to sell off, that we can eventually just collect some of the dividends or just take small profits on if we want to, pull it out. Because again, if you can make 10% on a 400K or 500K TFSA, guys, that's insane. That's 40 or 50K a year of tax-free income. And I want to remind you, if you work for 60 or 70,000 a year, guys, the government's taking 10, 15K of that. So you're to make 50K a year, you really have to be making over 60 right after taxes. So it's insane to me that we could make a full-time salaried income completely tax-free, excluding all of our other accounts, excluding our RSPs and our my corporate account and all that, right? So this is my path to financial independence. This is how we've been approaching it with the TFSA kind of being the core focus. And again, we use it to purchase a piece of real estate. So we're still very privileged to have contribution room between both our accounts beyond this. And I told you guys my financial independent goal was by 35 to hopefully have most of the property paid off and have our tax advantage accounts maxed. And that would give us basically between all our accounts, a very healthy salaried income as though we have a third person working for us. And I want you to hear what I'm saying about total returns. I'm not talking about this from a dividend standpoint. I don't really care about the dividends all that much. And I just can't hammer that home enough because I just see so many Canadians detrimenting their long-term potential by, I mean, you'd be better off just focusing on an S&P or a global market ETF than just being like, I just want a cash flow passive income from pure dividends and pure Canadian dividend stocks, because it looks great when you're getting that 5-10% yield, let's say. In some cases, people are going insane with it, and you're finding highly risky investments that are yielding way higher than that. But regardless, if you're just focusing on those yields, guys, you'll notice that yield stocks dramatically underperform the indices over long periods of time. It's just a fact. Companies that are more mature pay dividends, and more mature companies that don't know what to do with the capital to invest it aren't going to give you the best long-term returns. Like Google, that's investing in self-driving. Self-driving is going to be a $1 trillion industry in the future. Everyone knows it, and there's very few companies working on it. So you want to make sure you have some exposure to that if you're young. Not if you're older. If you're older, I get the dividend path and the more passive and, more diversified portfolio. But in those early years, guys, to a level of concentration could do you so well and put you in a very similar position that put me in. Again, I'm not stating this as financial advice, guys. I just want more people to be prosperous, because I'm not a guy that wants to get to the top of the hill on my own. Like, I want to do this together with all of you watching this channel. So I'll pass the question off to you. I'd love to know what you're doing with your TFSA down in that comment section below.